Happy Friday. Hope you're having a great week. We had a relatively quiet week in the markets in terms of mortgage rates. Rates are off their highest levels of the year, which we hit a couple weeks ago. And so we've had a nice little run of improvement since that point. But really, the biggest news that we're looking at right now is the incoming chair, Mr. Kevin Warsh of the Fed. And he comes in on the 15th of May. And he wants to take the Fed in a lot different direction than it's been going for the last, really 20 plus years. The Fed has been too involved in the markets and specifically with buying bonds. And you look at the last time the Fed did significant bond purchasing, that was during COVID. They bought treasuries, they bought mortgage-backed securities. They also lowered the Fed funds rate, but all of those asset purchases resulted in mortgage rates that were in the twos. And once mortgage rates got into the twos, we saw real estate values go up 60% on average across the country. Some markets, it was more than 100%. That created this lockout effect that we now have in the real estate market. And so what Mr. Warsh wants to do is let the Fed's balance sheet run off and not reinvest that money. So it was over $8 trillion. Now it's over $6. So he wants to continue to let that balance sheet run off while keeping the Fed funds rate low. So that is very different from what the Fed has been doing. It'll be interesting to see how the markets react to that. But when the Fed gets in and they buy bonds, that's essentially the same thing as printing money when they're buying treasuries. And so the increase of the Fed's balance sheet is inflationary in and of itself. And so by letting that balance sheet run off, that should help to temper inflation, which is good for rates long term. It's also good for the economy long term. So it'd be really interesting to see how this goes in this new chapter with the Fed. But we're feeling optimistic about it, looking forward to it. Hope you have a great weekend. Talk to you soon.